Good morning, guys. It is Monday, March 4th, 2024. This is Bathrobe Business. I am out of coffee. I already chugged it all, but I still have the news. So let's jump into it. So I'm going to talk about gold a little bit. I know this isn't a popular subject, but I think it's an amazing indicator. So for those that watch my channel regularly, I do mention gold a lot. This isn't because I'm one of those invest in gold guys. Not that there's anything wrong with that. All I'm saying is I'm not personally invested in gold. I just use gold as an indicator simply because so one of the businesses I own, we track alloys. So I have alloy data up here that goes back like 20 years. I've been in the family business for a long time, so I know gold prices. I know where they have been. I know where their normal baselines are. And so that's why I talk about gold a lot, because when gold starts doing weird stuff, that's when weird stuff happens in the market. And what I'm going to be talking about is the current gold price. So gold has been on a steady increase for the last year or so. If you watch this channel, you know I've reported that as it's gone up. Now, I've been kind of silent on gold for a while because it has been in a baseline of about $2,040 for the longest time. I think this is going back till like about October, November when it hit that baseline. It has not really deviated too much from it. It's been up one day, down the next. But that $2,040 baseline, specifically that number, seems to have been a new bottom that it has hit and is not deviated from. It seemed to be like this is the new gold price. Now, why that's concerning, for those that don't follow gold, that is a lot. That is a high number for gold. So traditionally, gold is not above $2,000. Traditionally, I guess I should say for the last 10 years, gold has been fluctuating between 1,300 and 1,800. That has been its more or less fluctuation points. When gold hits 2,000, something is wrong in the markets. There were two major events when gold hit $2,000. The first was the financial crisis of 2008. That's the first time gold had ever hit the $2,000 mark, and it may have exceeded it even at that one point, but then remained at about 2,000. And as the economy improved, its price began to drop lower, and it settled down around the $1,400 area, and it fluctuated in that area, maybe up to $1,600 at some points, but it was always below 2,000. Then 2020 hit, COVID, lockdown. Gold once again skyrockets to 2,000. But even after that, after everything reopened, after real lockdown, nationwide lockdown had ended, even though some states obviously were still locked down, the gold price began to diminish and go back, and it had settled around 1,800. And despite all the stimulus, despite all the inflation that had occurred, gold didn't really skyrocket all that much. Despite the fact that we had it wasn't quite double-digit inflation. I think it hit 9% at one point during the summer of 2022, if I'm remembering correctly. Gold did not skyrocket. Gold just simply remained where it's supposed to, below $2,000. And then over the last year, it has steadily increased and has now settled at the $2,040 mark and has pretty much been there ever since. I have not reported on it because I didn't think any of the fluctuations were noteworthy. Except yesterday, when it hit a new high of 2,080. Actually, before I went to bed last night, it was at 2,090. And right now, this morning, it is at 2,100. So that is a scary number to be at. Now, what is causing this? Well, there's multiple factors. I think I keep stumbling. There's multiple factors as to why gold is increasing. For one, internationally, its use is going up. Large countries buy it as a reserve. So China has gold reserves, Russia has gold reserves. The United States, I think, has the most gold reserves of any other country. So central banks do buy this currency, as well as consumer markets, gold watches, bracelets, and stuff will move the market a little bit as well. But I think inflation has finally caught up with gold price. That's the first thing. But this latest move from $2,040 to $2,100 is, I believe, in response to some sentiment in the market that interest rates are going to be cut in June. I'm still fighting this. I don't think the data is there yet. I think one number on PCE last week does not justify the cut. For one, the Fed needs to see a consistent change in inflation, A. And B, it was still at a 2, even though it was on target, it was still at 2.8% and not the 2% target. But in response to this, that people think that U.S. rate cuts are going to come in June, Gold has gold has risen to $2,100. So why this is scary? If this doesn't signal inflation, I don't know what does. If the Fed does cut interest rates and the economy is, to use an old adage, off the chain, it's let loose, you're going to see people start buying and selling houses at an exponential rate, refis going up, much more movement happening in the economy. The economy is going to start getting hot again. Inflation is starting to get hot again. And gold is going to skyrocket further. I'm not saying this to buy gold. I'm just saying this as a warning because this is already, before anything has happened, gold is starting to skyrocket. And if gold is a reserve, that means inflation is going to skyrocket. So if Jerome Powell has any wisdom, he's not going to cut interest rates anytime soon because the fact that gold is already above its traditional standard price and just the thought of cutting interest rates is causing it to skyrocket already. You're going to see massive inflation again if he starts cutting interest rates. It's going to signal something very powerful in the market because everybody is talking about it. Currently, one of our businesses is going through an acquisition. Knock on wood, we hope to get it by the end of the month. We're looking to acquire a new company. And we are going to benefit from lower interest rates. Even 0.25% is thousands of dollars a year for us. And because of that, a lot of companies aren't moving on new deals. They're holding off on deals. The market is deflating, at least in a merger and acquisition environment, because nobody wants to move because interest rates are still high. The second interest rates drop, it's going to be that the floodgates open and we're going to see massive movement, and I think we're going to see massive inflation again. Let's not forget, I talk about this all the time. Let's take inflation out of the equation. Let's pretend inflation never happened, right? There was no issue with inflation for the last 3 to 4 years. Normally, what does the Fed do with inflation rate, with interest rates? If the economy is running hot, it raises interest rates. If the economy is running slowly, they cut interest rates. The economy is still doing very well. And if they cut interest rates, it's going to boil over. So I know it's a political year. Everybody says that interest rates get cut in a political year. I haven't actually done the research to see if that's true or that's just public sentiment. I think that is worth a Google. But I don't think that it is wise to cut interest rates in this current environment. The economy is just still running too hot and inflation is still simply too low. And everybody is anticipating this in order to start making deals and spending money in what I believe are reckless ways. So that's that story. I'm going to set that aside for the rest of the day. I'm just going to hit the next few stories rapid fire. I think that was kind of my headline story, the one I wanted to focus on the most, and the one I think needs the most profound contemplation, in all honesty, is gold, interest rates, and inflation. But the next I'm just going to hit rapid fire. Bitcoin is topping 65,000 as it nears its 2021 record high of 67,000. There is, I think, inflationary pressures there as well, but I think a lot of this is precipitated by the ETF. Oil, that's another one that is probably we're going to be seeing higher prices. So the current oil market, current oil prices per barrel are $80.15. Let's not forget, just a couple of weeks ago, it was probably at the end of the year, I was reporting $72 a barrel. So we're already up $8 a barrel. And now Saudi Arabia, and I should say OPEC plus, so this Saudi Arabia, Russia, and I think there are other countries in there, but those are the biggest takeaways. They're still maintaining a cut in production. So they're still actually 1 million barrels short. They have been for the last 2 quarters. For the last quarter, and they're going to extend it for another quarter into June. So they're going to maintain a barrel cut of 1 million barrels a day. And Russia is cutting about 500,000 barrels a day, 471,000 barrels a day until June. This is definitely going to drive prices higher, but it will be yet to be seen. So we're going to keep an eye on that. Last couple stories I'm going to cover is, I think this one's just funny and interesting. Maybe not funny, maybe a little terrifying, but Chipotle founder Steve Ells is planning to revolutionize the restaurant industry again with a company called Kernel. This is going to be a plant-based company, so all vegan or vegetarian dishes, but they're going to be cooked entirely by robots and AI. I think this is not actually anything that new. We've seen multiple stories of these little robotic chefs. I remember being in San Francisco. It was like a year and a half ago. My cousin was baptizing his son, and we went to San Francisco. And at the airport, they had a little robot that made you coffee. I thought it was cute. So I think this is coming. It is a little scary, obviously, from an AI perspective. But I think given the fact that unemployment is as low as it is, I don't think this is going to displace people as much as a lot of people think. I also think it's not as easy as a lot of people think. What most people neglect with AI, with mechanics, with robotics, is how much troubleshooting these things actually need. So in one of our companies, we have a lot of CAD/CAM software, a lot of industrial 3D printers. These things need a lot of maintenance and a lot of technical prowess. I'm troubleshooting this stuff sometimes on a daily basis. And so the more tech and infrastructure you add to a business, yes, you may be cutting out low-level employees, but you're actually just creating a new job, which is new maintenance and new troubleshooting for higher-level employees. So I think this isn't as simple as it sounds, because it at the end of the day, a lot of these robotics and AI companies become more expensive than just hiring a teenager for $15 an hour, and a lot less stressful in a lot of ways. Because, if the teenager doesn't show, there's always another teenager that could take his place. You hire him the next day. If the robot machine doesn't work, you have to call a guy to come out and fix it, and it could be days before it gets up and running. We've had CAD/CAM mills. We actually still have a CAD/CAM mill that has been down for 2 years because they can't figure out what's wrong with it. So it's either buy a new one or just let it sit, and so we're just letting it sit. That's that story. Last story I'm going to cover is Macys and Arkhouse. Now, this is a story I've been following a lot. I've talked about it repeatedly. This is a story I first started tracking at the end of last year when Arkhouse Management, they're a big venture capital fund, were extending an offer to purchase Macys at $6.5 billion. Macys refused. And just last week, I reported that it's the start of a proxy war at Macys with Arkhouse Financial. And now today, they have just increased their offer to $6.6 billion, so up $100 million. That may not sound like a lot, but it actually is, because remember, Macys is down right now. So when they first offered their $6.5 billion deal, Macys stock was at a much higher rate. I don't remember what that price was. I can look it up. But Macys has had a major downgrade in the last week as they had disappointing sales. So raising it $100 million, I think, is actually about 15% better offer than the Macys had just 2 or 3 months ago. And with the proxy war coming and this much pressure on the board, it's getting very difficult for Macys to fight off these attacks. Now, I am actually rooting for Macys in this, because there are multiple scenarios of these venture capital funds coming in, just selling off the company piece by piece, and then the company disappears. I don't think it's good for the economy. I think this is why I am such a huge proponent of high interest rates, is it makes it more expensive for companies like this to do it. Obviously, they have cash reserves. There's no question. But when you can take that cash reserve and buy a bond and make money off of that, rather than risking it in the public market, a lot of these companies just do that. Because why go through the hassle of buying Macys, doing all the work, tearing it apart piece by piece to maybe get a return, when you have a guaranteed return of 5, 6, 7%, whatever the bond market's going to be, if you just purchase the bond. So I think having high interest prices keep these kind of destructive forces outside of the market. That's pretty much it. I got to get going. I got to get to work. I'm already late. I will see you guys tomorrow. I hope you have a productive day. Thanks.